The Quarterback, Tuesday nights at 8 on News Channel 5 Plus.
Hi, everybody, and welcome back to Score on Business. I'm Bill Denny. Don Bingham and Ken Davis are SCORE counselors, and they're here with us today. And you know, there are about a half a dozen styles of business structures that a startup business can select. Each of them have advantages and disadvantages. A lot has to do with the number of investors involved in a particular business, or the size of the business from a capital investment standpoint, or the risk involved. All of these things are very important in the way you style your business. So Don, Ken, let's talk about structures and styles.
Okay, and you're right, Bill. There are a number of different structures that small business can get into. But let me kind of go through them. Before I start, I really strongly suggest to any small business, before they set up their structure for their business, that they talk to an attorney and maybe an accountant, because there are risks involved, and you need to weigh those risks. And I'm going to start off with one that's probably the most popular, and the reason it's most popular because it's the easiest to sign up for and it's the least expensive, and that's the sole proprietorship. Sole proprietorship, and it's got its pitfalls. Sole proprietor means it's you. For instance, if I start a sole proprietorship, the name of my business, no matter what I want to call it, is Don Bingham. It's me, which means that something happens to me or I want to sell it, it has to be restructured, okay? So what you need to do if I want to do a consulting intelligence firm or something like that, and I want to name it, then I have to go to the Secretary of State and do what they call a DBA, doing business as. Once I get the title for my business, then I can use that on all my letterheads, business cards, any type of my website, what have you. There is. But remember, it's sole. Something happens to you, you can't even pass it on to a family member. So that's one of the pitfalls. Then one of the biggest ones is the risk and the what you have at risk. I recently talked to a startup business that wants to do a transportation, was going to start a sole proprietorship. If you have vehicles in your organization, you do not want a sole proprietorship, because what happens is with a sole proprietorship, because it's sole, it's not only what you have invested in the business you have at risk, it's anything that you own personally is at risk. So you need to put, if you are going to operate equipment or what have you, or have employees, sole proprietorship's not going to work for you because people get hurt or people come back after you. So you need to put a shield around your personal assets, and we'll get to that in a minute on how you do that. The second one is a general partnership. General partnership can be, and happens a lot, not as much as it used to, because general partnerships are destined to not to do well. And the reason for that is you go in, you may have your best friend, but once you get in and you start to see work ethics come into play, financial responsibility comes into play, all of a sudden there's nothing in there to keep you together, but it's just a real challenge for you. If you're going to do a general partnership, if you go to our website, scorenashville.org, and click on templates, resources, you'll see a template in there for an operating agreement. There's over 30 different points in there, and you've got to have that agreement in writing, so everybody knows what their responsibility is in that particular partnership, and then I would have it reviewed by an attorney to make sure it's correct. That said, now we get a little bit more also. General partnership, again, you have your personal assets at risk. If something happens to the company, not only do they get what you've invested in the company, they get what you've invested personally and your partner as well. So partnerships have struggled for years, so that's the reason that the newest structure is called a limited liability company. You'll hear it referred to often as an LLC. An LLC is a hybrid between a corporation and a partnership. So in this case, you get the shield around your personal assets, and you only have exposed what you've invested in the business. with that, you can have multiple partners. It could be one person or it could be multiple partners. The second one is an S corporation. An S corporation is where you can set up and actually talk about having shareholders, limited number of shareholders. I think it's limited at 100 shareholders. So, Ken, you're the accountant. Do you want to talk about the different taxation on these different structures?
Sure, and just quickly, when you are an LLC or an S corporation, those taxes are going directly to you as an individual or to the partners pro rata as individuals, as opposed to if you're a C corporation, you are taxed as a corporation first, and then as those assets are dispersed, then you are taxed again on those receipts. So there is an advantage to an S corp. I just quickly want to remind you that if you're in startup and you have expenses beyond your revenue, be sure you report that on your income tax so you can carry forward that loss.
Very good. And that's too is there's one of the things that whether it's LLC or S corp, you really need to put together an articles of organization. And if you want this information, I'm going to give you the website to go to. It's a wonderful one. It's Tennessee, tn.gov/business. Take you right to the Secretary of State, and all these forms and processes and all are out there on that website. So a really good resource for people.
Great job, guys, in getting a lot of information out there in a short period of time. Terrific job.
Yeah.
Knowing what style is best for your startup business is really important. Next, our guest today, Don Lair, is here to talk about the Social Enterprise Alliance. And you'll want to hear this. Stay with us. We'll be right back.